Welcome back, everyone. My name's Doug Burson, and tonight we're going to talk about taxes, and more specifically, how you can still save taxes on last year. Have you just gotten a call and found out that you owe for last year's taxes? Or, like a lot of you, you haven't gone to see your accountant yet because you know you do owe for last year's taxes. So tonight, we're going to talk on some strategies about how you can actually lower last year's tax liability now. So that's an important thing. We've been talking a lot lately about COVID-19, and we needed to. There's a lot going on, and there's a lot that we just had to take care of. But the truth is, the taxes, they still are due. We still got to take care of it, and we can't just pretend it's not going to happen. July 15th is going to be here before you know it, so we need to start planning and taking care of what we have to take care of. So with that being said, let's go ahead and get started on my first point. So number one, what you can do is you can fund your HSA. And all you really have to do is you have to have a high deductible health plan. So as long as you had a high deductible health plan in place for last year, you can fund an HSA even if you don't already have one set up. All you have to do is go to your bank or somewhere like that that actually takes care of those, and you can set up an HSA and fund it for 2019. Now, if you're single, that means you can fund up to $3,500. But if you have a family, you can fund up to $7,000. That means we can take $7,000 of your taxable income and make it non-taxable today. And so all you have to do is set that up. Now think about it like this. If you're in a 12% tax bracket and you have a family plan, you can save over $800 on your tax return by simply making a contribution to your HSA, which you're going to use for medical expenses that you had to spend anyway, or it's a great retirement vehicle. But if you actually have a 22% tax bracket, you could actually save up to $1,540 by funding your HSA, and you're going to use it for your kids' braces anyway. You might as well get a tax break. Now, number two, and we've all heard about this, but so many people just forget to do it, is our IRA. You can actually still fund your IRA all the way up till April 15th, just like on an HSA. But you say, Doug, April 15th's already passed. That's okay this year because of everything that's going on. They actually are allowing us to go all the way up till July 15th to fund both the HSA and the IRA. So what that means is you can do $6,000 into your IRA and get a tax deduction right now for last year. If you're married and you qualify, both of you can do it. That means $12,000 into an IRA. And let's say you're over 50, you can add an additional $1,000 a piece. So you could do $14,000 into your IRA today and make it pre-tax. So if you're in the 12% bracket and you're married, you could save $1,680. And if you're over 50, even more. But if you're in the 22% bracket, we could save over $3,000 by simply funding our IRA. Now think about this. We just saved $3,000 in our IRA, and we could save another $1,500 in our HSA. We just saved $4,500. So I think that's really good news and something that you can think about. And if you think some of what we're talking about is helpful, go ahead and hit subscribe. Do it down below. It's going to help us. And we really are trying to do our best to give you guys good information that's useful and relevant. Now, number three on the list is something you might not have thought about. It's depreciation. You can do bonus depreciation or Section 179 depreciation and reap massive tax savings. I'm talking about big, big money. And you might want to check and make sure that whoever's doing your tax return, or if you do it yourself, and this would be a common mistake if you do it yourself, that you forgot to choose to do bonus depreciation or Section 179. And you probably need to talk to your tax advisor to find out why you would want to do one versus the other. There are times and they do fit in different ways. However, think about this. You can do up to $1 million in Section 179 for last year. And if you've already bought the equipment, instead of doing it over time, if I take $1 million deduction, You could save hundreds of thousands of dollars by just choosing to do Section 179 on your tax return. Now, obviously, we can't go buy equipment last year, but we do have the option for whatever we purchased last year to choose to do bonus depreciation or Section 179 while we're preparing our tax return. We didn't have to make that decision when we purchased the equipment. So make sure if you've got a tax liability and you bought equipment for last year, that your preparer did not forget to take Section 179. And on a side note, if they did forget, hey, give us a call. You probably need a different tax preparer, but that's a whole nother story. Right now, I'm just trying to help people. So we'll get back to our number 4 point. And that is, our number 4 point is the home office. So often people are scared to death of the home office because they don't want to put a red flag on their tax return. Well, the truth is, if you're doing what you're supposed to, what are you afraid of? If you really have a home office, if you're really keeping records like you should be, you got nothing to fear. I once had a client, I don't know, probably been about 10 years ago, and he got audited by the IRS because he had 40%-ish, I don't remember exactly, but it was a large percentage of his house that he was taking for home office. And so when he got the IRS audit, the main thing they wanted to look at was that. And so they wanted to do the audit at his house, which they will do from time to time. And so what I did is I went over and looked at his house to make sure that he was going to be okay. And sure enough, he was really using that much of his house for a home office. So we went through the audit. The IRS agent came to his house and did the entire audit. We walked him through, showed how it was all set up, and it was legitimate. So the auditor had to let it go. So don't run away from home office just because you're afraid of an audit. If it's legitimate and we're doing what we're supposed to, take the deduction, because not only does it help there, but it can also help substantiate your mileage every time you leave the house. So it's more to it than just the home office. So I really think a home office is something that a lot of people are afraid of, and they really don't need to be. And if you have a home office and you're still afraid no matter what I say, they've added something a couple of years ago called the simplified method. And it's a safe harbor, and you can just do $5 a square foot up to a $1,500 deduction. And the IRS has pretty much said, look, if you take the safe harbor, we're going to leave you alone. So if they've said that and they've got a safe harbor, why are you not deducting it? And that's something that you can still do for last year because you had the expenses. You were just afraid to do it. Don't be afraid. Take the home office deduction and put some money back in your pocket. So the number 5 thing on our list is a SEP IRA or a profit share to your contribution. Now, many of you already have a 401k, but you never went through the process of setting up the profit share. Well, that can still be done. Matter of fact, even if you don't have a 401k, they have now said through the Secure Act that you can actually set up a 401k plan for this year, do a profit share for last year, take a deduction on last year's taxes for money you contribute this year. Do you see where I'm going? This is crazy. And get a deduction for it. And it can be for big money. So if you don't know about this, get with your financial advisor, get with your tax advisor. There's a real opportunity the IRS has done here. And to make it even more, why are we not doing this? They've also allowed up to a $5,000 credit for doing this because they want people to put money in. So this is a real opportunity. If you've been thinking about setting up a 401 for your company, but you just haven't gotten around to it, this may be the time to take care of that and get it done. So that's a real opportunity. But for some of you that you may not really need a 401, but you could do a SEP contribution. And you can do a SEP contribution all the way up until the filing deadline of your tax return, which means you could go all the way into September, maybe even October, and still fund your SEP for last year. And you can do up to $56,000 into your SEP. So if you're in a 24% tax bracket, we just saved $12,000 or more by just funding our SEP, which you know you need to do anyway. So why are we not doing it? we need to think about the future, because who knows when the next thing is going to happen, and you need to have your security taken care of. You need to fund this for you. You need to fund it for your spouse. You need to fund it for your family. We need to take things serious, and the government's trying to pay us to do it. So why aren't we doing it? So let's think about that. And there's more to do with the Secure Act. There's a lot of opportunity there. I don't really want to get into that because it's beyond the scope of this. And maybe we'll do a separate video and bring in an expert on just the Secure Act and share some of that with a third-party administrator and go through some of that. But that's for a different day. And I know I said 5, but I just couldn't not talk about this. And I'm going to throw in a bonus one if you want to say that. It's unreimbursed expenses. If you have a partnership and you're paying for expenses, you're paying for your own mileage, you're paying to entertain clients, you're paying for your own computer, cell phone, etc., you can deduct that. So often, if you're in a partnership, you don't pick up all the expenses because you know the other partner doesn't necessarily want to pay for that, or you just don't want to have the discussion over why you're using this or you're doing that, but you're doing it for the business, you're trying to build the business. The expenses are deductible if, and check with your attorney, check with your tax advisor, you got to make sure the operating agreement allows it. But if it does, you can take deductions on the partnership that were paid by you and not by the partnership. You can deduct those on your tax return as an unreimbursed partnership expense or an unreimbursed business expense. Depends on who you're talking to, a UPE, UBE, same thing. You can deduct those expenses right on your tax return. And so many people aren't doing that because they just don't know about it, and they don't want to turn in the expenses to the partnership and have a whole discussion on why they did this or why they did that. Or maybe you drive more miles than the other partner and it's just hard to make it fair, or I don't know, there's a lot of different things. But as long as the operating agreement allows it, this can be a big deduction. For some people, this could be $100,000 deduction depending on how their arrangement is set up, and it can be a massive tax savings. So I want to make sure that people understand, if you're in a partnership, make sure your operating agreement allows it, and this could be a big way for you to offset the expenses that you're incurring and previously were not deducting. So there you have it. 6 instead of 5. I threw an extra one in there. I couldn't help myself. Six ways that you can save money on your taxes for last year and not pay them until this year, and in some cases all the way up into the fall through the extensions on your tax return. I know it sounds crazy, but it's fully legal, and I want to make sure you take full advantage.